Hello and welcome to Wholesale Investors Small Cap 2021 conference, where today on our panel, we will be discussing momentum versus value investing and what wins in 2021. We have some incredible insights today from Ron, Justice, John and Robert. And I think to kickstart, let's hear from you, Ron. What does momentum versus value investing mean to you, and how does it apply to what you do every day?
Yeah, sure. Thanks for having me. Look, value investing versus momentum, I think everyone has a bit of a different view of what it means to them. For us, value investing relies on, looking at company fundamentals mostly, and, using financial metrics of a business like profits and cash flow and different balance sheet metrics to value a business. So, metrics such as return on equity, return on invested capital, the asset base and so on. And, these businesses usually priced on relatively low multiples or valuations, a PE multiple or an EV to EBITDA multiple. I think that it takes into account, I think value investors maybe don't look as much at sort of industry tailwinds or disruption to the sector. They're more focused on those fundamental elements of what makes a stock cheap or undervalued. And to us, momentum investing is more looking at a big picture thematic. So, looking at thematic that is currently growing. So usually companies that are, disrupting an industry or, doing a lot of innovation. So could be technology and so on. And then, these are businesses that usually have a really sort of fast growing revenue base, and they're scaling quite quickly, but they also tend to make losses and burn lots of cash and raise equity quite often. And so the valuations in this sector, are more based on, say, a revenue multiple. And then usually the market leader in that sector is considered the benchmark for actual valuations for others in the sector as well. So, I think that that's sort of the difference that we see between the two. And we actually think that investors should use both.
Sure thing. Well, Ron, you are, of course, the head of Australian equities at Tamim Asset Management. And we also have Rob here, who is the head of distribution and investor relations at Collins Street Asset Management. I'm keen to hear from what Ron said. How do you agree or disagree, and what is your approach at Collins Street Asset Management?
I agree with most of what Ron has said. At Collins Street Value Fund, we're deep value contrarian investors, and we focus on absolute returns rather than returns which are relative to a benchmark or an index or something like that. As the old saying goes, you can't eat relative returns. And so for our investors, preserving capital and growing their wealth in real terms is what matters. So for that reason, when we look at companies, we look at a lot of the same types of metrics that Ron said. We look for companies with low price to earnings multiples. We look at companies with low debt to equity and the like. But what's really key is that we spend a lot of time in the field getting to know management, the board, customers, suppliers and the like, so that we can arrive at an intrinsic value for the stocks that we're investing in, which we can have a high degree of confidence in. Anything that falls outside of this, particularly with the realm of momentum investing, starts bordering more and increasingly encroaching upon the realm of gambling and the role of speculation. It really requires a belief that something continues to go on, and invariably results in a game of greater fool, where you require someone in the future to pay more than what you pay today, based on no change in valuation or fundamentals. So we tend to focus strictly on the financials, really get to understand an idea, rather than gamble away with clients' money.
Sure thing. And John, I saw you nod your head there, but how is this different or similar to your approach? And perhaps if you can start by outlining what it is that you do.
Yeah, thanks, Little. Yeah, I've been running my own business for about 30 odd years now, helping the companies to list on the ASX. So I joined the company as a director and then help them through the process, manage the lawyers and accountants and everybody else and the capital structure, introduce them to the brokers, help them to to raise capital, and then help them to list. And then I generally stay on for a couple of years to help them through the transition from private to public, because it's quite a big change for a lot of people. And the modus, the whole operation is because if the CEO tries to run the process of doing an IPO, they take their eye off the ball in terms of the business, and the CFO as well to some extent, and B, they've never done it before, so they fall into all the old traps. I've done 25 or 30 floats, so I've pretty well seen most of the traps. I won't say you find a new one every time, but at least we can deal with them. So that's what I do. How do I look at a company that comes to me and asks me to help them? I tend not to worry whether they're momentum investing or value investing. It could be either, could be both, could be neither. What I tend to look for more is who are the people. It's very much like Robert said. They must be passionate, have integrity and intelligence and energy, ethics, and so on. But I also look at the unique selling proposition. Where does that? What is that? And does it meet a demonstrable need? It's not just, we'll build it and they'll come. That doesn't. That's had it. And then the next, you look at the total addressable market of a business to see whether, in fact, there's worthwhile. Must be easily identifiable. Is it worth doing, or is it a tiny market? And then you look at other things like the IP protection and the business model. Is it easy to understand? You've all heard the term the elevator pitch. Well, that's very important. If you can't explain what your business is about in a few floors, then give it away. And then obviously on that, if you might be able to explain your business plan, but you've got to be able to execute on it too. So you need good people to be able to do that and so on. And you obviously need the money that you raise. And then lastly, probably not least, is good governance. I'm a great stickler for having governance within an organization, and I help private companies put the governance in place. So those are the sort of things I look for in a business, and whether they're momentum or not, I tend not to go with momentum investing. I think momentum investing is just a fad right now, because there's a lot of people that are making revenue or making eyeballs, as we used to call it back in 2000. I guess from my point of view, cash is probably more important than all of those things. An old colleague or an ex-boss of mine that ran the whole of the outfit I was working for in London about 30 or 40 years ago told me that a good business is one more money comes in than goes out. And I've never forgotten that. So I think that's where I stand on these things. I think it can be either.
Sure thing. Now, among everything you said, you did mention the elevator pitch, and we only have one ASX CEO on our panel today, and it is Justus, who has just recently listed MadPause on the Australian Securities Exchange. I'm keen to hear your elevator pitch for your company, and then perhaps when you introduce who MadPause is and what you do, if you can also tell us what response investors had to MadPause in the lead up to your IPO, and following your IPO, what investors do you believe are most attracted to your company?
Thanks for having me. So yeah, the elevator pitch is quite easy. We're Australia's leading pet service marketplace. So there's a lot of pet owners out there, and through COVID, you can imagine there's a lot more out there. I think most people know somebody or have themselves gotten pets over the last 12 months. And so if you need somebody to look after your pet, you've gone on a holiday, so you need to go back to work, you can go into madpause.com.au and you'll find a local sitter to look after your pet either at your own place or at the pet sitter's place. And we've been doing this for now 5 years plus. And like I said, are the number one player in the space. And we recently also launched an additional revenue stream, which is Dinnerbowl, which is a pet food subscription service, which delivers pet food straight to your doorstep. And so the experience in terms of getting listed on the ASX, we had our listing just about 4 or 5 weeks ago now. It's obviously a very exciting moment for the company. We're I think in a very good position to kind of benefit from the tailwinds that we're seeing from COVID. There's numbers now in the US, that pet ownership has grown by over 20% in the US. There's no official numbers yet in Australia, but we expect very similar numbers to see here. And on the back of that, I think the interest in Madcourse for the IPO was phenomenal for us. We raised $12 million in the IPO and $5.5 million in the pre-IPO, which puts us in a position now to execute on the strategy that we have to benefit of those tailwinds.
Okay, and I think it's terrific that we do have you on as an ASX listed CEO here on the panel. Ron, when it comes to other ASX listed companies, could you give us perhaps some examples of what you'd consider momentum investments or value investments? And if your clients are asking you, how do I diversify, and perhaps get a bit of both, what your recommendations are to them?
Yeah, look, so I think a really good example of momentum investing, over the last sort of 12 months or maybe a few years as well, has been the the emerging sort of thematic and the sector of the buy now, pay later. So that's a classic example, of a new and emerging industry and a service that really is sort of replacing the traditional credit cards, more appealing to a younger generation that don't want to use credit cards. They want to use this budgeting tool of installment payments. And obviously we've had sort of the emerging leader like Afterpay emerge and take market share, and then others followed like Zip and Sezzle and so on, and many others. And I think that's a classic example where the value investors and they would not invest in companies like that because they were all loss making and burning cash, and very hard to justify buying these businesses. But these businesses were disrupting a big industry that has a huge runway, and they were growing quite fast. The revenues were scaling really quickly, as I mentioned before. And then investors that took a big picture view of things and said, well, if this can continue and these businesses can take a certain market share from, for example, from the credit card market industry in 5 or 10 years from now, then there will be much bigger companies. And so we've seen that actually evolve, and companies like Afterpay and the like, they've succeeded in taking huge share, and they're still growing, and we've seen the valuations, and the returns to those investors who back this so-called momentum investing in that sector do really well. We obviously did benefit from that sector. We did invest in Sezzle last year at under $2, and we took it all the way to $10, and we did sell out. So that's one, for example. And obviously, there's always going to be sort of new industries and new thematics that emerge that play into momentum investing. I think at the moment, there's a bit of a transition away from some of these momentum thematics, and the tech sector and the buy now, pay later, they've had their run. And I guess investors need to look for what's next. And then examples of value investing, well, to us, that's more, undervalued, profitable business that are experiencing tailwinds. So for example, the auto sector, the second used car vehicle market, after market for parts, that's doing really well with COVID and international border closures. We're seeing Australians take to the road. They're avoiding using public transport. They're obviously holidaying domestically, so they're using their cars more. So companies that are really cheap and screen really well on all the sort of value investing type metrics. Two companies that we like is National Tire and Wheels, and RPM Automotive, both supply car parts, wheels, tires, and so on, mechanical repair shops in the sector, and both are trading on very low PE multiples, are profitable, are growing, cashed up. And that's just kind of examples of companies in both sectors.
Thank you, Ron. That's very, very, very interesting. And Robert, when it comes to your views and perhaps some examples of value and momentum investing, what have you really seen in the market, and what feedback are you getting from clients in terms of where they're looking for value, and what has taken your interest?
A lot of our clients are private investors, people who have run businesses in their own way and take a very pragmatic approach to how they're assessing a company. And so for that reason, the buy now, pay later space, which is one Ron discussed before, for our clients just has too much in the way of hopes and dreams baked into it. When you're seeing companies trading on price to earnings multiples, or even more frequently now being quoted on price to sales multiples, But if we just go back to price to earnings, sometimes well over 100 times, not what they're expected to earn this year, but in future years, is just a bridge too far. And put back another way, I'd ask the business owners in the audience to this session to ask themselves, if someone came to them looking for a job and tried to negotiate a pay packet, a salary, that was 200 times the amount of revenue they were going to bring into that business. Not today, but in 2 years' time. Would they get the job? I'll throw it out there as an open question.
Once again, I think John agrees with you. What are your views on this? And could you give us some examples, perhaps, of momentum or investing stocks that you think might be a good pick or ones to avoid?
Oh no, no. Look, I'm not into sort of picking and recommending and stocks, but I will say, I'm probably older than most of you put together. I've been around. I don't know if everyone's aware, but since the turn of the century, there have been 31 stock market crashes. People only remember the really good ones. I remember 1987 very, very well. And I can tell you, in 1987, all the stocks that you would today have put into the momentum basket all went completely to zero. And those that were fundamentals held their value reasonably well and came out of that downturn. That was a massive plunge. I mean, that was 20% in a day. I can recall stockbrokers and investors jumping out of city building windows. And I kid you not, I did see one. And since then, we've had the dot-com bust. We've had September 11. I went on Google and had a look at them all. We had the financial crisis, the flash crash when the Dow dropped 1,000 points in a day, the China crash, the cryptocurrency crash. And don't forget that there was a period where Bitcoin peaked on the 17th of December and then dropped 42% by the 22nd of December. I count Bitcoin as very much a momentum thing. And then, of course, the COVID pandemic. That was a pretty severe crash. Dropped 34% on a day in February, and it's come out since then. So I always look at investments from the point of view of hope for the best, but plan for the worst, and expect there to be a crash around the corner. And if that's the case, would I rather have my superannuation fund invested in Afterpay or perhaps CommBank?
National Tyre and Wheels are great stock as well.
What's that?
I said National Tyre and Wheels are great stock there as well.
Yeah. So that's my view. I guess I'm a bit risk averse, probably because of my age, but also because of my experience in seeing these things happen over many years. And the companies that I invest in today are the companies that I help to float. And I do a lot of homework. I work for 3, 4, 5 months with companies before I agree to join them and do this process. So by then I know them inside out, and they've ticked all the boxes that I mentioned earlier, and that way I take them forward. But whether they're, I have done plenty of what you would call momentum stocks. I listed companies that had no revenue at all, like indoor skydiving tunnel. And I've listed other companies that had nothing more than a device for snoring and sleep apnea. That was Somnomed back some number of years ago. That's still playing out today. But they've changed the business model 2 or 3 times to fit the circumstances. So I guess I'm probably not a great advocate for momentum stocks as much as I am for value stocks. And I think that's where I sit.
Okay, and Justus, from your perspective, as we mentioned, you've just listed your company on the ASX. Would you say that a mad pause is more attractive to a momentum or a value investor? And how are you trying to position the company to attract your ideal investor?
Yeah, very good question. I mean, I think it's very, it's very much a definition question on kind of what you call momentum and what you call value. I mean, I'd definitely say, successful investors are probably going to look in at both and finding the right balance, right? So I think that's the first thing. You want to have something in your portfolio that has the potential of growing, significantly more than paying you a 5% dividend and making a couple of percent over the years. And on the other hand, again, like the balance is probably the right thing to look at here, right? So from a MadPos perspective, we're definitely thinking of ourselves not as a momentum stock in the traditional sense. I think we've got very good fundamentals and very good growth for the company to show for, and particularly in the industry that we're in. We see some very, like we've had continuous growth over the last couple of years, and we see that kind of going forward. So again, it comes down to a little bit in terms of definition and what you call momentum and what you call value. We obviously see a lot of value in MadPos. Sorry. And I myself, I'm an entrepreneur, so I normally back myself more than anything else. And so for us, what we look at, and also for me personally, what I look at is always, the combination of the opportunity and the risk that you take. And so, we're working on this business because we believe it's going to be a huge business. And we've started this business, 5-6 years ago with exactly those intentions of what we're executing now. And that's the opportunity that we see then in terms of the growth of the business, which has been very much focused on services. Now, kind of using the customer base that we've built with over 100,000 paying customers on the platform now to extend that into additional revenue streams. And so, for me personally, when I look at investments, I'm come from the private sector. I've very much kind of in tech investments and startups. That's kind of what I grew up with over the last kind of 15, 20 years. And so it's very hard to say that I'm a value investor, right? Because most of the companies that I've invested in lost money for the beginning of their journey. But the successful ones were always, 10 times plus return companies. So, that's kind of what I invest in, is really the opportunity and the people that run the business. And obviously, I back myself and the businesses that I run, and I back teams and in the other businesses that I invest in. And so, from that perspective, I think from a private market perspective, you definitely see a little bit of a change there as well, where I believe it was really very much about value investing over, the last couple of years. Now you see a lot more kind of competition also in the private sector, where PEs and VCs come in and pay valuations that are probably a little bit, ahead of where the companies are at. But sometimes you have to do it if you believe that the company is there and the opportunity is there. So, again, it's a little bit of a definition, but certainly we see value, obviously, in what we do and in the business that we build.
Absolutely. I must say, on a personal note, when you listed, I was so interested, and I thought this makes sense to me right now, because it reminded me of a friend of mine in Melbourne who was desperate to buy an animal, a pet, last year during lockdown. And at the beginning of Melbourne's lockdown, they were looking around for a pet, and it was a few $100s to buy one. And by the end of Melbourne's lockdown, it was thousands of dollars to buy a pet. Yes. And then when I saw that you listed, I thought, wow, it makes sense for this to happen right now. Yeah. And I suppose while we're talking about COVID, we've really barely seen the other side of COVID and its implications. And I'm keen to hear from you, Ron. Have you seen, I'm sure you have seen opportunities. What opportunities have you seen really with COVID in terms of momentum and value investing? And looking forward, how do you think your investment thesis may evolve as a result of COVID?
Yeah, sure. Look, so, obviously last year, we had the sort of March lockdowns and, the markets tanking, and we really kind of took a pause and really tried to understand sort of in April and who are going to be the winners and losers of lockdowns. And obviously we sort of realized quite quickly that the COVID winners that we called, and we sort of, by talking to management teams and understanding what was going on, we could see who could benefit and not. And so we, obviously the COVID winners back then were e-commerce companies, people shopping online, locked down at home. Retail businesses generally as well did quite well. Payments companies, obviously electronic payments, buy now, pay later, as people were shopping online or trying to avoid the use of cash. They were the COVID winners. the whole work from home and remote working environment. So there were many technology companies providing software solutions for remote working. So they were big winners. And obviously telco businesses, having those solutions and faster connections and all kinds of, business products in the telecommunication sector to enable companies to manage their workforce. So they were the COVID winners. And then, as we sort of, came out late last year from lockdown, especially in Australia, and we're seeing that happen more, say, in the US now and the UK, they've had a large part of their population vaccinated. So everything is reopening again. And we're seeing their sort of COVID winners becoming a bit of losers, some of them, especially in that e-commerce space, for example, where people are spending more time out, they're shopping less online. And so the winners for us at the moment are the so-called vaccine winners. So as I mentioned before, with more sort of domestic travel, for Australians and in other countries as well, the whole auto sector is doing really well. So both companies supplying parts, selling cars as well. We've seen a lot of supply shortages for new cars and so on. So the second-hand car vehicle market has done really well. And then companies that are providing sort of finance for used vehicles, such as, for example, Money3 and the like, are doing really well. And just generally, I think consumers are pretty cashed up, and they want to spend the money that they've been given from the government or that they haven't spent in the last 12 months. So we're seeing sort of the retail sector, but more the sort of bricks and mortar now, rather than the e-commerce, doing really well. People are shopping, they're going out, they're traveling, they're holidaying, but they can't spend that money overseas, so they're spending it here locally. So those are the sort of winners that we're seeing at the moment. And I think as international travel resumes for us Australians at some point, then I think you'll see some other stocks benefit as well. Maybe obviously the obvious ones like the overseas holiday booking, flight travels of the world, the Webjets, but they're already priced in. So maybe companies that provide foreign exchange solutions for travelers, like OzForex, for example, that we like and is very profitable, and so on. So that's sort of how we kind of changed our approach from COVID winners to vaccine winners.
Okay. And Robert, obviously COVID impacted everyone. How did it impact your investment thesis? And how do you anticipate perhaps your approach to momentum or value investing may evolve as a result of COVID?
Coming into the COVID crisis, the Collins Street Value Fund had 35% of its portfolio value in cash. And that's one of the wonderful things about having a flexible investment mandate. You don't have to do things to all people all the time. And it's not that we predicted COVID or pandemics or anything else like that, far from it. But we'd taken a view very early on in the game that the average Australian consumer had too much debt in their balance sheet and that the share market overall was quite expensive. So whilst it can be very difficult to identify the precise straw that's going to break a camel's back, it's not all that hard to find a tired and weary camel. And that's how we felt the market was looking coming into 2020. So during the depths of COVID, we were able to deploy our capital into a range of companies to actually increase our exposure to some names that we like and assist in the recapitalisation of some companies who had good business models, but perhaps had former management teams that hadn't steered it in the right direction and the like. One company, which I've mentioned before and which we agree with Ron, is National Tyre and Wheel. This is a company which we did quite a lot of research on throughout COVID to try and understand if the consumers weren't going back buying more tyres and the like. But as it turned out, rather than buying new cars and so forth, consumers were spending more money upgrading their existing cars. And so there's quite a lot of bottom-up research we could do with tyre franchisees to get some perspective on that, but also cross-match that with other data around what people use to also upgrade their cars, be it through various accessories, parts, window tinting and the like. The other thing which was quite strong and positive about National Tyre and Wheel is the diversity of their client base. Yes, they have the off-road vehicles and the like, but they have agricultural transport vehicles, those sorts of things as well. And so where different parts of the economy can move at different rates, they can participate in that. So how did our investment thesis change as a result of COVID? It didn't change, I wouldn't have thought at all. Our focus is really to identify the absolute best investment ideas we can. And for that reason, we hold a very concentrated portfolio of 8 to 20 stocks, and to focus on those companies which can withstand impacts such as COVID, or can withstand things before that was after that was the US election. And so a lot of people are holding off and concerned with this impact stock or would not. We're looking for quality management teams backed by strong balance sheets that can see things through. And where we can find those ideas, we'll absolutely back them with conviction. And that's something that we continue to do in fund. And there have been some companies which you asked before, well, they're about the winners. What I would add to Rob's point before is that we saw a lot of the JB Hi-Fis, the Nick Scali's, being winners as well, as people were spending more time working from home, so JB Hi-Fi does well. Nick Scali, people are looking at their furniture around their home, and naturally this goes quite well. But I would ask anybody who's tried to buy a new couch or a TV or those sorts of things of late, what their experience has actually been. And we're seeing that now a lot of that backlog of inventory has been expired and exhausted. And there are now actually significant delays in terms of getting a lot of this stock through to the consumer. And so what was a tailwind for a lot of these companies through COVID is now actually starting to hang as a cloud over them. So for us, we continue to maintain conviction in our portfolio. We've got some companies which have very little rhyme or reason to the Australian market, such as ASX-listed uranium stocks, which continue to perform quite strongly for us and are largely uncorrelated. Again, providing a tailwind to returns throughout 2020 and certainly through 2021.
Some very interesting insights there. And John, I'm keen to understand from your perspective how COVID impacted your views and approach to investing. And looking ahead, we've certainly already heard some summaries of the winners of COVID. Looking ahead, which sectors do you think are really poised to do well? And how would you be approaching investing when it comes to momentum and value investing amid this period, which is still a period really of COVID and emerging from COVID?
Yeah, thanks, Lil. Yeah, what's really quite interesting is that my view there's quite a lot happening in the healthcare space. There have been a number of companies that have come up and doing the healthcare online and so on, and they've done quite well. I'm director of a company called Volpara, and Volpara is into analysis of mammograms to detect breast cancer. And in the early stages of most of our 90% of our business is in the United States, and in the early stages of COVID, all the clinics shut down and stopped doing mammograms. Within 2 months, they started up again because women were demanding they needed to have their mammograms, and breast cancer wasn't going to go away just because of COVID. So those clinics started up, and we are now seeing almost twice as many mammograms now per month than pre-COVID. And as a result, we're now analysing far more of those. We, in fact, Volpara now touches 30-something% of the US market of women with one or other of its products. And we've diversified that business from simply analysing mammograms to helping clinics manage their business and also helping them to report their business to the FDA and others. So it's a very sticky product. We're in the largest hospitals in the United States. And the recurring revenue that comes from it, we also switched from a one-off sale of capital items to a recurring revenue model, which 3 or 4 years ago meant that we had to take a downturn in revenue to implement that new system. But now we've now got, I think, nearly 90% of our revenue is recurring revenue. So they're contracts that everybody pays every month and so on and so forth. And so it's gone incredibly well in the last 6 months. In fact, the last quarter just had our best quarter ever. And that's coming out of COVID. And people are now seeing that these things like cancer don't go away and they need to be treated. So I see that. I'm also director of another company out of New Zealand called Aroa, ARX is the code, and that's in wound healing. And whilst elective surgery also fell off a cliff in that March-April period last year, it's now come back and is now going even stronger than ever. We've had much stronger sales in America, and the company's doing really well. Interestingly, both of those companies, you could almost call them momentum investing companies, because we've taken the view that rather than pushing towards cash flow break even and profitability, that we're better in those instances to obtain market share. And we're now spending every dollar that comes in on grabbing more market share. And we're now the leading, Volpara is the dominant player in breast care, breast health in the United States, other than the large equipment manufacturers. That is a different model, different make. So we have taken that longer term view, and that's paying off because we're now owning a lot more of the space, but we're providing a product that everybody wants. So it's good from that point of view. So I see healthcare as being a major area to invest in the future, because as soon as people can get all these COVID people out of the ICU, there's a whole bank up of people ready to go in there for their elective surgeries and other things. So that's where I'd be putting a lot of money.
Absolutely. That's a very...
Not that I'm an investment advisor. I'd take my hat off to Robert and Ron on that basis.
But it's certainly a sector that you like.
Yeah, very much.
And another theme of COVID and COVID investing was that we really have seen a resurgence of IPOs on the ASX. And again, Justice, coming back to your ASX IPO, I'm keen to hear what made you list on ASX right now, how you felt the investor appetite was towards Mad Paws in the lead up to your IPO. And given COVID, how do you expect that your business may have to adapt in the future, or is it already positioned to really take advantage of many of the new trends we're seeing as a result of COVID?
Yeah, a very good question. I mean, COVID obviously impacted us, being closely related to travel. We saw a dip first in our revenues at the beginning of COVID. But as I mentioned before, after the initial shock of what kind of happened, we kind of realized that really long-term COVID is a huge tailwind for us. And, the guys have been talking about, particular sectors that might be benefiting from COVID or have benefited from COVID. Like we, not quite surprisingly, but are truly believers in the pet space in terms of long-term winners of the COVID effect. Because if you think about it, whether it's payment services, subscription services, or anything like that, a lot of those services customers might cancel once COVID, we return to normality after COVID. But, once you've got a pet, you're stuck with it for 10 years, and that's great because people love their pets and people are treating their pets more and more like their own family. And that's really kind of what we've seen throughout the time of the pre-IPO and IPO, that investors are really interested in that thematic. People have seen it. It's kind of very easy to touch and feel for people, talking to neighbors and people in the street to see how many people have actually gotten pets in the last couple of months. And so from a thematic point of view, I think we were just in the right space. And I think that's why we had a great demand for the pre-IPO and IPO. And the company is really set up to benefit from this long term. We've built, like I said before, the marketplace is kind of our core business, where we've got 100,000 plus customers on there. But we're kind of really in a special space now where we can use the data that we have on our customers to benefit us to add additional revenue streams going forward. And I've mentioned before that we've started doing pet food subscription services now. So we're a big believer in the subscription service space. I think that's something that's been, coming out of COVID again, a couple of big winners out there, HelloFresh in the US or Marley Spoon here in Australia in the kind of human food space. But normally what happens is once something takes place for humans, the pet space kind of lags a little bit behind that. So I think within the next couple of years, we're going to see a huge surge in subscription services for pets, and that's definitely one of the parts that we're going to play in. The other part is obviously data. Data is for any business, I think these days is hugely important, but particularly in the pet space, we're very well positioned to kind of take advantage of that. Like I said, we don't only have 100,000 paying customers on the side. We've got over 500,000 people on our database. We've got nearly 1 million people coming to our sites now per month to get information about pets. And all that means we learn more about pet owners, what they want, what they need. And that's really what we want to use going forward to offer the right products and services to them. So really what we're building is an ecosystem here from pet services and pet products in the subscription space, making sure that we're much more competitive than some of our competitors in the space, just tackling one part of that equation. We're really kind of building an ecosystem for pet owners to make pet ownership easier and make sure we present the right products and services at the right time.
Great. And I suppose for our last round of questions, it would be helpful to look at an outlook. And before we get to that outlook, I'll start with the fact that the ASX last year released an investor study saying that we have a record amount of millennial and female investors investing into the ASX, which also means a record amount of investors that require education. So really, as accessing trading to public markets becomes more and readily available, we're seeing some new trends emerge with retail investor behaviour. And Ron, I know that you're active on Twitter. I'm keen to hear your thoughts in terms of what have you observed in terms of this influx of new investors, and perhaps are you advising people that have never invested before? And when it comes to momentum and value investing, what would be your guidance to someone looking at the ASX for the first time?
Yeah, sure. Look, there's definitely a new type of sort of behavior or trend that's been happening. There's essentially, since lockdown happened in March last year, sort of a new generation of investors have emerged. Again, that younger generation that was locked up at home, was pretty bored, relatively cashed up, not spending money, going overseas or going out, receiving government handouts and so on. And, they're getting zero in the bank. Interest rates around the world, in Australia, have essentially gone to zero. You're getting nothing for your savings. And I guess it was also quite an opportune time in terms of sort of the markets tanking. So most of these sort of new investors that came on board, and there were, tens of thousands and millions of them around the world, kind of picked the bottom. So since then, they've all done really well. And we've seen that sort of social media sort of trend in investing emerge, the memes of the world and the Reddit forums trying to sort of get everyone together to buy a stock and take it higher. And I think a lot of these younger investors, they're also buying sort of brands that they can associate themselves with. They're recognizable and they actually use them every day. So, the Afterpays of the world, Zip Money, Tesla, even like, for example, Airtasker, which listed only a month or two ago. I was quite surprised at the way it sort of performed a few days after listing. And I had messages from friends that never invested in their life asking me, how do I open a brokerage account? I want to buy shares in Airtasker because I've used it. So it just shows that, we've seen this sort of a trend emerge. And, unfortunately, and now obviously we're seeing it in the cryptocurrency markets and not on the ASX, but in the crypto market. And that's, we're seeing that happen as well. And unfortunately, there's, some prominent figures out there like Elon Musk, who's adding more sort of fuel to this fire and encouraging kind of, inexperienced investors to do it. The problem is that, unfortunately, I think as John mentioned before, history does repeat itself, but it does repeat itself kind of differently. And I think, it's inevitable that most of these investors will get burnt and will probably lose money at some point. Definitely in the cryptocurrency market at some point. And I think in ASX, we're already seeing it, those stocks that did really well and everyone made a lot of money on, for example, the Afterpays of the world, they're all down 30, 40, 50% in some cases by now, as that sort of, there's a bit of shift in momentum. So I think definitely new investors should be cautious, and they should definitely, whether, educate themselves on different forums, or I guess they just don't have the same maybe advantages that more experienced sort of professional investors, fund managers have, because we have that regular access to management teams. We spend sort of full time researching this. And I guess experience does count in this industry. And, for example, I've been investing for 18 years and, you've seen quite a few crashes and crises, and you sort of kind of learn how to deal with that. So yeah, definitely I recommend investors be cautious and educate themselves as much as they can.
That's a very true and very good advice. That experience, certainly in this industry more than most, does count. And Robert, on that note, have you come across any new investors that you feel need some guidance or some lessons? And how would you recommend they avoid some of the risks that have arisen in the past year?
Very true. We're a wholesale fund, so we don't deal into the retail space. So my interactions in that world are limited to that extent. But what I would say by observation, and I concur with what Ron has said, as the old saying goes, when somebody with money meets somebody with experience, the person with experience will get the money and the person with the money will get the experience. And it's I truly hope that a lot of people who are going into the share market for the first time are doing so in a way which is progressive, which is gradual, and which is part of a broader education journey. Because it is very important that people take ownership of their financial futures, but you don't want to confuse luck and skill as being the same thing. And for that reason, I think it's important that people, if they are unsure, that they do seek professional advice from someone who's licensed to do so. And they spend a lot of time reading, understanding, and working out what their investment philosophy fundamentally is. Because that will be what guides them through market environments and various investment ideas, both now and into the future.
Absolutely. And John, your advice perhaps to new investors or anyone getting tempted by some quick returns?
Yeah, well, don't be fooled by your success. That's the first thing I'd say. And the second thing I'd say would be, spread your risk. I mean, don't put all your eggs in one basket. Don't go all out on momentum stocks. Don't go all for value stocks. Don't go all for dividend stocks. Just spread it around a bit, because when the markets crash, and they inevitably will in some way, shape or form, it may not be that across the board. It may be only tech stocks like it was in 2000, or it may be only other types of stocks that are in other times, Asian stocks, for example. And 1987, I mean, everything came apart, but the value stocks, the ones that had fundamentals, if I could call it that, rather than value, fundamentals, they came good pretty quickly. I saw something which I sent to my son the other day. I said, it's a company called StockX. It plans to kick off in Australia. And their business model is to sell second-hand designer sneakers, like Nike Air that's been worn by some famous dude somewhere or other. And they've valued this business at $4.9 billion. And they're a second-hand sneaker dealer. I mean, seriously? I mean, I just get blown away by that sort of stuff. I can't countenance that. I mean, it just defies all logic. And when you defy logic, eventually logic will prevail. And eventually these values will come off. Like Ron said, eventually the cryptos and the Bitcoins and all those things will come crashing down. I don't know when. I'm not a soothsayer, so I can't tell you when. But inevitably, when something gets pumped up to such an extent, a bit like my bike tire, if I just keep pumping, eventually it bursts. So you've got to look at the meter and say, have I gone too far, So
yes,
I'm sorry to be a bit of an old, fuddy-duddy, but, that's life. There's no such thing as a free lunch. It's not a good one.
That's a very true line. And Justice, I know that you mentioned you've also invested and being an entrepreneur and seeing the current climate, having put your company through an IPO recently, what would be your advice or recommendations to people looking to start investing now, or maybe even continue their investing journey post-COVID? What do you think that they should be wary of, or perhaps looking for opportunities to?
I mean, I kind of agree with most of what the guys have said before. One of the things I certainly have learned is that you've got to be quite aware of kind of how much time you have to spend on something to become an expert in something. Particularly in momentum investment, which always sounds kind of very tempting to make a quick buck. This can be quite hard sometimes, and you've got to spend a bit more time on actually looking at those investments where value, and again, when you're using John's there, maybe looking at fundamentals and taking a long-term approach. Sometimes it might be the better thing to do if you don't have the time to follow stocks on a daily basis. And that's certainly something that I've learned along the way for me. I look at fundamentals of businesses, people that I really trust in terms of a long term. It's going to be a great business. And that's kind of what I invest in. And that takes a little bit more time at the beginning of the investment, but makes it much easier to let this stuff ride and believe in, if you have high conviction that you've done the right research at the beginning, to let those things ride out. And then, the things that John has mentioned, ups and downs that will happen on the market, you can get through them much easier if you know that you've got a company that provides value in the long term. So, I think that's something that I've learned along the way, and taking a little bit of a longer time horizon in your investment scenarios makes those decisions a little bit easier.
Well, gentlemen, thank you so much for joining us today for Wholesale Investors Small Cap 2021 conference. It's been a pleasure to discuss the difference and value between momentum versus value investing. And I'm sure you've given our viewers lots of insights to consider on their investment journey.
Thank you.
Anna.
Thanks.